Beware the concentration conundrum in passive global equities. Global equity funds attracted £7.7 billion of net inflows in 2019, according to Last Word Research. To put this into context, UK equities amassed £45 million as investors opted for the safety of international funds against a backdrop of political and economic uncertainty at home. However, as investors breathed a sigh of relief following December's general election result, is investing so much globally still a good strategy in 2020 and beyond? Ben Yearsley, investment consultant at Fairview Investing, does not anticipate changing his allocation to global funds over the coming year. One of the reasons for leaving the allocation alone is the relative value in the UK market, he says. It's still one of the cheapest globally, and with political certainty I think it will do well. Turning to global equities, where possible I have switched funds to hedged share classes, to take out some currency movements from overall returns. The pound does look cheap on many measures, and it is a headwind to future returns if it rises. Hedged share classes are not widely available, though. Mainly Japanese funds offer them, but also a few US, European and global ones. Within his global allocation, Yearsley says while he doesn't underestimate the power of US markets, he sees better value in Japan, Asia and emerging markets. Notwithstanding the coronavirus outbreak, which will affect short-term GDP, these areas remain cheap with good long-term growth prospects, he says. I will be adding into these areas, mainly at the expense of the US. Great long-term growth prospects allied to cheap prices is an ideal combination for longer-term investors. Counting the costs, Justin Onuekwusi, pictured, LGIM fund manager and head of retail multi-asset funds, says global equity funds that track the FTSE All-World or MSCI Equi offer exposure to over 2,000 constituents at a fraction of the cost of their active equivalents. However, many investors are not aware of the concentration conundrum they now face. U.S. companies dominate the global index, he says. The big 5 U.S. stocks in the global index, Alphabet, Amazon, Apple, Facebook and Microsoft, have a higher weight than the whole of Japan, and also higher than Germany, France and Switzerland combined. The whole of the UK is just half of the weight of these 5 tech giants. This level of stock-specific risk has made the underlying index more sensitive to the news flow on these largest companies. Onuekwusi adds dissecting the performance of U.S. equities reveals that, at extreme periods such as the first half of 2018, the Big Five explained almost 90% of the S&P 500 return. The remaining 495 companies were a sideshow. This is not the well-diversified and balanced exposure many investors in index trackers look for. Indeed, investors face a concentration conundrum, yet index trackers go for more. On this story, visit the news article link.